Hello, I'm Scott Hood, Market Development Manager for Legal & General. Welcome to this webcast on company share purchase arrangements, which can be part of the succession plans for shareholders of private limited companies. This is aimed at those who are familiar with conventional company share protection arrangements but wish to consider another route. A number of options are available to shareholders of private limited companies who are concerned about what would happen to the control of the company and to their families should one of the shareholders die. One option, the traditional route, is to enter into an agreement where life assurance policies are taken out on the lives of each of the shareholders. The policies are set up in such a way that should a shareholder die, the other shareholders will benefit from any proceeds, for example through the use of a specially drafted trust. As part of this arrangement, the shareholders will enter into a shareholder agreement, perhaps a cross-option agreement. This means that when the surviving shareholders receive the policy proceeds, there is a legal mechanism through which they can purchase the deceased's shares in the company. This gives the surviving shareholders the ownership of the business and provides the deceased's estate with a cash settlement. Whilst this has been the traditional method of share protection, there are points that need to be considered. For example, where trusts are used, there will be a need to appoint trustees, and those trustees will need to administer the trust and consider any tax consequences that can arise. In addition, it is often the case that the company will pay the premiums on behalf of the shareholder, which could lead to income tax and national insurance liabilities. This traditional route is well established and often provides its participants with a great deal of comfort as to what will happen or what options are available on the death of a company shareholder. There is, however, another method, company share purchase. This involves the company buying back its own shares from the deceased's estate. The company would take out a number of policies on each of the lives of the shareholders. In the event of the death of one of these shareholders, the policy proceeds will go to the company itself rather than to the surviving shareholders. The company then has a lump sum of money which could be used to purchase the shares from the deceased estate. If the company does purchase the shares from the deceased estate, the company would then cancel those shares. By reducing the number of issued shares, the proportion of shares owned by the surviving shareholders increases. The surviving shareholders keep control of the business and the deceased's beneficiaries receive a lump sum of money. So far, this seems very straightforward. There is no need for trusts or trustees or to think about the taxation of such trusts. Also, policy premiums paid by the company would not be taxable benefits for the shareholders. This is because the company owns the policy. Equally, the company could not claim the premiums as a business expense. There are, however, many other things to consider with this type of arrangement, and a company looking to enter into such a plan should consult with their legal, financial and taxation advisors due to its complexity. For example, in order for a private limited company to purchase its own shares, the company's articles of association must not prohibit it from doing so. There must still be issued share capital remaining following the repurchase of shares. The shares being purchased must be fully paid. The shares must be paid for on purchase. The contract to repurchase the shares must be approved in advance by a special resolution. Also, a private limited company looking to repurchase its shares must first do so out of its distributable profits, or a fresh issue of shares made for the purpose of financing the purchase. Only once any distributable profits have been used can the company use its capital to purchase its own shares. This may also have an effect on its ability to pay future dividends. Whether profits, capital or both are used, there are many legal requirements that must be adhered to, and there are penalties for non-compliance. Because of this, it is important that those considering such an arrangement get legal advice and understand the risks not only at the time the company enters into the arrangement, but also in the event of a claim. Advice will also be required on the inheritance tax, corporation tax, income tax and capital gains tax implications.